Good afternoon. This is Coach Mike from WinningStockCoach.com. Going to go over a little bit of a market overview for the upcoming week. It was a very, very interesting week. Monday through Thursday, Monday through Wednesday really, but Thursday too. Markets kind of charged up on very low volume, but made some good prices. The non-farm payroll data came out and missed the expectations on every statistical category. Yet the markets gapped up. The S&P 500 gapped up to an all-time high on Friday before falling hard and fast, which was great for the members of the coaches roster. In our chat room, we were just killing SPY puts options for multiple 100% winners. So it was a lot of fun. We enjoyed it. But I want to show you something here on the weekly chart, and I'm showing the standard mountain chart. We haven't discussed the weekly for a couple weeks now. We've really been, as the markets have been consolidating, we've really been focusing just on that day-to-day movement and some different expectations to make. I want to show you that this chart here is showing weekly closes. And even though the S&P 500 created two different price highs, it has yet to close a week higher than what my Fibonacci time series tool showed me as the week of March 3rd that we talked to for a couple weeks leading into that, how we believe that would be a market high close. And so far it is. And I wanted to start with that because we're actually starting to see not only, if we look at the volume traded on the SPY, which is the Spider S&P 500 ETF, and you look at it really since, I'd say about May, June of 2013, you really started seeing volume trading well below the average daily volumes. When we got into November, December, it went from just being well below average to kind of just disgusting. And over the past month and a half, even though the prices have kind of bebopped around to give you opportunities at different highs, though failing to close at them, we found that the volume is now just outright untrustworthy. And the reason I say that is when you see things going up or going down, as the volume is decreasing to pretty much non-existent, that there is your best indication that the direction it is currently moving in is about over. And as we've seen these levels of volume decrease by pretty even percentage increments since, with each step along the way since May, June of 2013 and coming into now 2014, it's been quite funny to see the price action intraday in relation to daily closes and weekly closes. One thing I want to point out here on our daily chart, and this is a daily chart using the candles on the SPX, is we had a nice angle in our trend, and the dotted line trend comes from the close of weekly each week. So that's why you see some prices above and below, because they're simply based on the closing prices of the weekly chart. But you see we had a pretty consistent angle to our highs. And then now we come to a time where we again have a consistent angle, but that angle is changing. Though it is still trending upwards, we are starting to see a change in that angle overall. So what is it we kind of need to look for here? Well, here's where I stand on it personally. It's hard to deny the fact that we've been consolidating pretty tightly with moderate up moves since March, since the first week of March, really. And that leads me to believe that with the size of this fall and seeing how comparable it is in size to a day like this over here on March 13th, it's very likely that maybe tomorrow just gives us a small down day, bounces maybe around this 1855.42, and just stays in the consolidation pattern. That's very possible. But I want to watch that 180 or 1855.42 for it to break down. What this will do is this will help me to gauge the effect of that non-farm payroll data, to gauge the effect of the horrid volume, and see that if we will at least come down and trade within this channel, this blue colored channel, and maybe come down around 1783.08. Now, the reason I'm looking at these potential targets and telling you how I would react on them is because of this consolidation pattern and the consistency with it. It's likely that maybe you get a small red day. Maybe it's not even a red day, but it just comes down and touches and does its thing. You have to be prepared. One thing I tell members of the coaches roster is you can't, while you should pre-plan your trades to have an idea for the risk to reward, what your projected entry is, where your targets are, and all that, you do need to pre-plan your trades. You can't convince yourself of trades before the opportunity is shown to you. The reason is many times people say, well, I'm buying here no matter what, and sometimes it just falls right down through you. And yep, you got your buy no matter what. And it ended up not being that great of a buy. So you need to approach with kind of a neutral mentality, because that neutral mentality is going to help you determine your risk to reward in every trade, and to see the markets for what they are doing and not for what you want them to do. So, plain and simple, big hard down day on Friday. Possible for a small down day and a bounce? Yes. Why? We've seen it before. But have we also seen impact from non-farm payroll data and missing on the line items create a market pullback? Yes. January's report had a drop. They blamed it on the weather and all this, that, and the other. So you got a bit of a bounce, but it eventually fell. And where did the rise happen? With February's non-farm payroll data report. So now that we've missed on every statistical category, is it likely we could see a sell-off similar to what happened here that gets us down to at least this trend? Absolutely. How will we know that that's what we're looking at? It's going to start with a breakdown below 1855.42, and that would be a closing price for me on the S&P 500. I don't care if it just put a wick down and ran up. The closing price on a daily chart is what would determine my belief in that and would cause me to take appropriate action. I don't want to chase something to the short side right now for a very limited short opportunity. I would rather still, in a sense, chase it, knowing that I have a higher probability of falling lower once the 1855.42 is broken below. So it definitely comes down to risk management strategies, and if you didn't get in at the top, which everybody knows you'll rarely get the best buy and you'll rarely get the best sell, so you have to plan for acceptable areas in between there for your trades. And the acceptable area, should you have not got in the short side at the top, is to wait for that failure to give you a higher probability of much greater returns on short trades. Now let's assume you do get a bounce in this area. Trade it for the bounce. Watch your favorite charts, your favorite securities for stocks that are moving positive from support levels. Use those support levels as your stop to minimize your risk, and take appropriate action and make the trades. There's going to be a risk in every trade. You can't be afraid of the risk. You have to accept the risk before you enter the trade, have knowledge of where that risk level is, and simply make the trade from there. I'm going to take a look now at our DJI, the Dow Jones Industrial Weekly. And though on Friday the DJI went up to a new all-time high price, the close, the item that really matters, is what stands out. You had a really nice day. You gave it all back. or a really nice week and gave it all back, to close lower and still in between this horizontal channel that we have developed. And where we'll really get a gauge for strength or weakness of the DJI is for a weekly candle to close above or below this horizontal channel. If we monitor the current trading pattern for the short term and try to project a pullback target based off mathematical projections from this high to this low and then the run that was made, we could see the DJI pull back to maybe 16,172.92 cents to maybe give a bounce play and give some nice reaction from various Dow Jones Industrial Average charts. My concern is, again, like I was mentioning when we were just viewing the weekly chart, that until we get weekly candles that close outside that horizontal channel, we are pretty much going to remain consistently consolidating, which is going to make it difficult for swing type trades. You could make some good short-term trades and day trades, and for right now I think longer term trades are okay unless we go and fall below that lower channel line down here at these lows. And in the interim, we're kind of in a holding pattern with the Dow Jones Industrial Average. It's kind of a time where you have to take advantage just of what it gives you and not what you want it to give you. And at this time, it's a little bit difficult anytime you're in a consolidation pattern to get a good gauge of direction overall. So did they kind of head fake us a little bit this past week? Maybe. The volume wasn't anything convincing until we started falling, but it's still simply as a chartable pattern. You do have to recognize that on this pullback in mid-March made a higher low from the February lows, and we did just make a higher high, and therefore it is currently uptrending, though it may be uptrending at a lesser angle with a little more intensity to the downside. So something to definitely keep an eye on. I would for your DJI stocks, the 30 stocks involved with the Dow Jones Industrial Average, I would definitely be focusing on your DJI support levels before making any additional buys or additions to current positions for those charts. If you remember from previous videos, I've talked about how the RUT, the Russell 2000, the small cap index, has many times over the past 18 to 24 months served as a precursor indicator for the major indices, which small cap index doing that is not historically reliable for that, but it has been reliable over the past 2 years. And while the S&P and the Dow surged to new all-time highs, they're simply a few weeks behind the Russell 2000 that did it and has been creating lower highs and lower lows ever since. Now, if you look at various small cap stocks, you actually see replications in this same pattern. I told everybody back in January that I had exited my long-term small cap plays because I felt at that time that the upside potential was no longer worth the downside risk. Now, I want you to look at this. This line here actually indicates the area where I was exiting small cap positions that I've held for a longer term. And as you can see, as it fell, you had intense falls, not ever knowing if you would actually come back up again. Now that we're looking at the chart, we can say easily that, well, it did come back. You could have sold for a little bit higher. But again, let's look at the size of these pullbacks over the last year on this 1 year daily chart. And not a single one of them looked anything like our January pullback. And therefore my assumption there that the downside risk may be finally outweighing the upside potential. I didn't have to go through the additional 3 to 4 month wait to exit positions for just pennies higher than where I was able to exit in January, thus freeing up capital, minimizing my risk. And look at where we are now. Look at the chart over the past year. Every high was a higher high, and every low was a higher low until the February lows, which was our first lower low. It gave us one more higher high, and each time since has began a pattern of lower highs, lower low, lower high, and pennies from a subsequent lower low. I would not be at all surprised to see the RUT weasel its way down to 11-13.50, which will have an effect on your ETF, the IWM. But due to the intensity of the fall on Friday, I also won't be much surprised to get a little bit of an up bounce before continuing the fall, or maybe even some sideways movement like we saw during this time in March, where it had an intense fall. It bounced back, though closing red, gapped up the following day, as you can see, gapped up 2 days in a row, and then hammered down very, very hard. It could make for a very interesting and fun week for day traders. This is Coach Mike from winningstockcoach.com, encouraging you to plan your trades and execute based on your plan. Understand the risk of a trade before focusing on the reward of a trade. Capital preservation is what will keep you in the game. I also wanted to inform you that the Coach's Roster newsletter is running a special price currently for the setup for the first 50 that sign up for it. We currently have 19 spots available as of 2:15 p.m. on Sunday, April 6th. So if you are interested in checking it out, visit www.winningstockcoach.com. Check out the services page to get information about the Coach's Roster newsletter, being able to join us in our chat room and receive text and email alerts, as well as the educational value of the site being top-notch and best there is. So if you have any questions, you can email me at coach@winningstockcoach.com, and I'd be glad to discuss things personally with you. Best of luck to you, and God bless.